Hello everyone, GM. Welcome back to another episode of Overpriced JPEGs. It is your Wednesday interview episode, and today I am joined by Felix Salmon, who's the chief financial correspondent, yes, I got that right, for Axios. And Felix has been covering financial news for decades now. He had some great coverage back in 2008 of the financial crisis then, and I really wanted to talk to him to help us unpack what's happened over the past week, what the ramifications for this are, and to compare it a little bit to what's happened in moments in history, like in 2008, so we could get a clear perspective on where we are. We also end up diving into the crypto conversation a little bit, which had not been my initial intention. I had not geared myself up to fight to defend crypto, but that comes up a bit, and we really break down Silvergate, Silicon Valley Bank, and Signature Bank, which are all three different banks that have undergone some level of crisis in the last week. So I kind of bounce between them in this conversation because I really wanted to understand the differences between these three. I'm sorry if that's confusing. I know they all sound the same. I try to level set this a little bit up at the top of Silvergate is this crypto bank. Silicon Valley Bank is obviously more of a tech early startup bank. And then we've got Signature Bank, which was a little bit more of a hodgepodge of had a number of traditional banking clients, but also has been servicing a number of crypto clients. So that's sort of the breakdown of the three. We get into all three of them a bit in this conversation. I hope you really like this. It's obviously a little different than what we usually do here on the show, since it's not really just crypto focused, and it's certainly not NFT focused, but it just feels like this news is big, and this is something that I'm personally really interested in and wanted to bring you something. So let me know if you like this episode. Tweet at us if you are game for us to do some of these just broader breakdowns on what's happening in the economy, and not just breakdowns, but kind of trying to go deep and answer some questions that I know I've had lingering. A couple notes before we just fully dive in here. Tomorrow, if you're hearing this the day it comes out, this is airing on Wednesday. Tomorrow on Thursday, the 16th, you can go on to opjtour.com and you'll be able to reserve your seats. If you have an OPJ NFT, you'll be able to start reserving your seats for the very first OPJ live event, which is happening in Miami. We are interviewing Julian Holguin in Miami on March 30th. I'm really excited for that event. I think it's going to be a great one. If you hold an OPJ NFT, you can start reserving your seats for that event tomorrow on Thursday. It'll be first come, first serve. There's only 150 seats. And so and you'll have 48 hours as an OPJ NFT holder to reserve your seat, and then you'll be able to keep reserving. But after 48 hours, Doodle holders will also start being able to reserve a seat for that event. So you get an exclusive window of 48 hours for just you guys, and then after that, Doodles holders can also start reserving seats. Also, today is Wednesday. You may have already received, or you are soon to be receiving, the airdrop of the new OPJ NFT. There's nothing you need to do, nothing you need to worry about. It's going to look exactly, essentially, like the original, but we're upgrading some of the back-end metadata stuff so we can track things better on our end. So you'll be getting a new OPJ NFT. That's where all the utility will live. The old NFT will look quite different, so you'll know the difference between the two very easily. I've been saying this. If you fall asleep for the next 3 days and you wake up, you won't even know the difference. But I do want to flag that for folks. New NFT coming, and that is where the utility will live. And I think those are my notes. Well, also, of course, always reminding folks, we have a great Substack. We published our first deep dive piece on Tuesday for paid subscribers only. Been getting some really good feedback on that. So go check out the Substack. And if you're so inclined, you can subscribe. You can become a paid OPJ member. All right, with that, we're going to hear a word from our amazing sponsors and then on to the show. I am so excited to announce that this year, Overpriced JPEGs has partnered with OPENSEA, the world's leading NFT marketplace built for everyone, creators, collectors, noobs, and experts alike. I'm an OPENSEA user because they have the best selection of NFTs and a truly inclusive view of the ecosystem, supporting 8 chains and 8 global languages. I trust the systems they've put in place to keep the space safe, like copyright protection, malicious URL detection and removal, robust verification, and more. It's why they are the place to buy, sell, and create NFTs. That's right. You know OPENSEA, you use OPENSEA, but did you know that OPENSEA now has drops? New exclusive projects launch every week from top projects and creators, and you can check them out now using the link in the show notes. They also recently introduced self-serve drops, which is in beta, and allows creators to launch their projects right on OPENSEA. This Drops product gives creators access to tools like rich storytelling drop pages, multi-chain support, and drop mechanic customization. The full launch for self-serve drops is coming this spring. So check out the upcoming drops on OpenSea right now using the link in the show notes and own what moves you. You'll also be supporting the show in the process. Let me introduce you to a brand new company that I could not be more excited about, Web3 Sense. A Web3 analytics platform that combines on-chain data with social media insights to give you the deepest, most meaningful intelligence into any NFT community. I have tested other analytics platforms out there, but Web3 Sense has the most comprehensive capabilities I've seen in the NFT ecosystem. They apply sophisticated data science to wallet histories to determine behavioral patterns and help shape predictive analytics. In other words, they can tell you which Twitter accounts are actually the influencers in your space. And they can tell you what resonates most within a community by looking at what other communities token holders are involved in. The number of use cases here is virtually unlimited. So whether you're a trader, creator, institution, brand, agency, I promise Web3 Sense has data that you want to see with the deep and actionable insights that you need to build, analyze, grow, start, whatever you want to do within the NFT space and in terms of building a business and a community. Now, they are still in very early days, so they're eager to connect with the community. So if you're interested in learning more about what Web3 Sense can do for you and your business, and you should be, go and fill out the very short form linked to in the show notes, and someone from their team will reach out with more information and an opportunity for a product demo. Trust me, you won't regret it. Felix, thank you so much for coming on Overpriced JPEGs.
It's a pleasure.
I'm going to spare you. Well, maybe I'll ask you at some point your thoughts on crypto, but that is not why we are here today.
I have so many thoughts on crypto. You told me earlier that you're a fan of Planet Money.
Big fan.
I have had two high-profile appearances on Planet Money with Ben Horowitz of Andreessen Horowitz, and in both appearanrances, I entered into a bet with him about crypto.
Wait, that was you?
That was me.
About Bitcoin?
Yeah.
Wait, you're like the 2011 podcast where there was a bet about Bitcoin.
Yeah.
That is where I first learned about crypto. Was it like 2011, 2012?
It was like
happened?
2013, I think, maybe 2014. I can't remember.
So I am starstruck. I remember I was probably like, I don't know, how many years ago was that, right? Like I was like
a long time ago.
18 years old, 19 years old. And that episode really put crypto on the map for me. And I've been basically kind of following along in some way or another since then. And now, of course, I work in it. You were on the side that nobody was going to be, you won.
I won. Yeah. I have a pair of alpaca socks that I won from Ben Horowitz.
But here's for context for the audience here, I never do this, but I'm now so excited to just have this very brief conversation before we get into everything we were supposed to be talking about today. So this episode of Planet Money was Felix. I'm so thrilled to know this was you. This is so funny. This is so full circle for me. So Felix entered into this bet against Ben about whether or not Bitcoin would be used as money.
Correct.
In the next, over the course of the next, was it decade? It was a 10-year bet, right?
It was a 5-year bet. And then we re-upped it 5 years later.
Oh, okay. So functionally, it did last for 10 years. And so Felix was on the side that like nobody's going to be using Bitcoin as money. And then Ben Horowitz said that they would be. And while clearly you won, are you surprised by Bitcoin's growth, or I guess you wouldn't really consider it success? Like it still feels like Bitcoin has come a long way since that first episode aired.
I think actually, come to think, I think it was 2050. I think it was 2005, because I think the second bet expires in 2015. The first bet expired it would have been 2010. I think that's how it works.
Really?
We can look it
Planet
up.
Money. Yeah, we should look this up. But anyways, continue.
We can look it up. But one of the things which I said on the original bet was I do not want to bet one Bitcoin, right? Which was the obvious thing, because I have no idea what a Bitcoin is going to be worth. I have no particular dog in that fight, right? I know that Bitcoin has no social utility. I know that it's not going to be used for payments. I know there were lots of fundamental problems with it, which actually, ended up bringing down 2 banks in the past week.
Okay, all right.
But what I don't know is, how much someone is going to be willing to pay for it. So we deliberately did not bet one Bitcoin. We bet a pair of alpaca socks because famously one of the first things you could ever buy with Bitcoin was alpaca socks. There was this guy selling alpaca socks for Bitcoin. And then 5 years later, I won that bet. We didn't even need to do the poll. It was obvious that no one was using Bitcoin as a payments mechanism. They were just using it as a speculative bet on trying to make money. And I was genuinely 100% bowled over and surprised when Ben basically said, I wasn't wrong, I was just early, and it's going to become a payments mechanism. I was like, you have got to be shitting me. We have learned that it is not going to be a payments mechanism. He's like, no, in the next 5 years it will be. So we re-upped the bet. He's like, maybe not in the United States. I'm like, name any other country, I don't care. And for reasons which I can only hazard a guess at, the country he named was Mexico. So the second bet, which I think expires in 2015, or it might be 2014, we'll have to look it up. Sorry, I don't mean 2024 or 2025. Like, it's going to be in the next couple of years.
Okay, I was like, I was confused. I was like, is this a British turn of phrase that we are referring to? No.
What time has them? This is, by the way, I have a book coming out called The Phoenix Economy, and one of the big themes of that book is time has no meaning anymore.
Okay.
Like, since the pandemic, we just broke time. But at some point, the second bet will come due.
It looks like it was 2014 was the first, so you re-upped it in 2019, so it'll be expiring in 2024.
There you go. Perfect. So I have that to look forward to next year. This time the stakes are slightly higher. It's
two pairs of alpaca socks.
It's 1 ether.
Oh.
And a 100-year-old bottle of Madeira.
Oh.
And my thing was that I reckoned a 100-year-old bottle of Madeira would hold its value better than 1 ETH.
Oh, you're in enemy territory here, my friend. Well, so the only thing I want to push back there, and again, this was not intended to be let's have our own debate on this, but I think it is unfair to think of Bitcoin as nothing but a speculative vehicle. Unless you would also consider, it's the obvious argument, gold only a speculative vehicle. Like I joke that Bitcoin, and I'm not a huge Bitcoin person, right? I'm much more in the Ethereum camp, but is I call it my apocalypse play, right? Like it feels to me like it serves a similar purpose in my life that gold served to my dad. So
gold has an undoubted value as a speculative vehicle, right? Lots of people speculate on the price of gold. There are gold futures on the Chicago Mercantile Exchange. And it is not purely a speculative vehicle because it actually has a surprising amount of utility.
And you're like, because we can make jewelry?
Well, jewelry, and also it is used quite a lot in the electronics industry as well. It's an extremely good conductor. It's just about the best conductor of electricity there is in the world. And so it gets used in industrial applications. But one of my favorite charts these days is the chart of gold, the gold versus platinum price. Like, platinum always costs more than gold, right? This is why the platinum Amex is like a higher tier than the gold Amex. But right now, gold is like twice the price of platinum. And that's entirely a function of the fact that there is, more utility to gold, whether it's jewelry or electronics or whatever, than there is in platinum, because platinum is basically, we use it in catalytic converters, but ICE cars are, internal combustion cars are going away. And so, there's not much demand for platinum anymore. And the price is a function of real-world utility. And there is no real-world utility to Bitcoin.
In an apocalypse scenario where you couldn't have food or water or a necessity,
you would still have the interplanetary file service, and you'd be able to.
No. My question is I'm asking you a specific question of in an apocalypse scenario where you can't. Your answer to this can't be that you have that the thing you want is bread or whatever, right? What would you want? What asset would you want?
So wait, what you're saying is that in a world where everyone is stocking up on ammunition and canned goods, you're what are you going to what will you be able to trade for ammunition and canned goods in some So one of the super interesting history of money facts, and I'm sure this entire conversation is going exactly where you're expected it to, is there's this meme that a lot of people believe, right, which is that humanity started by bartering things for other things, and it was I will trade you this pile of grain for your leg of moose that you just killed with a rock or whatever, right? And then eventually money came along to sort of create this fungible thing that everyone could trade for, and you wouldn't need to find exactly the right person to trade with, who happened to have exactly the thing you wanted while they wanted exactly what you had, right? You can all just like abstract into money. This is completely false, right? Money long predates barter. If you are hypothesizing some kind of future world where like we're reduced to barter and you need something with utility, like that is never going to exist. There's always going to be money, and the money that we use, is not going to be cowrie shells, right? And it's definitely not going to be Bitcoin. And the most likely thing is going to be whatever scrip is issued by whatever government exists at the time.
I am not going to further us down this path, in part because we have way more, I wouldn't say important, but we have other things to talk about. And in part
there's a banking crisis going on,
yeah.
people.
And in part because I'm not entirely not with you in the sense that Bitcoin has, again, never been my horse at all. And I'm much more interested in blockchain as like a platform, and we can have that fight too, because I think we'll have the flipping someday, and Ethereum will beat Bitcoin. I do want to ask, one final question. As much as I said I wasn't going to go down this rabbit hole, would you accept if people were regularly using like a stable coin or something, I know, given the state of things over the past week, to transact, that was like backed by Bitcoin? If Bitcoin was being used in sort of a gold standard type way, would you count that in your bet with Ben?
Oh, absolutely. If it's crypto,
Okay.
it counts, right? So if people are using Tether to pay for stuff, if people are using ETH to pay for stuff, or Bitcoin,
That all counts.
or like if people are using Solana to pay for stuff, then he wins. But it does need to be in Mexico.
Okay. If only he had said El Salvador, it's like,
Well,
so
I mean, that's
close.
the whole point. If he'd said El Salvador, he would still lose.
Why?
Because no one
you're
is
saying
using
nobody's
crypto
actually
and
using it?
No one is
Well, what does
actually
no one
using
mean?
it.
I'm sure, obviously, some people are.
There are 3 crypto bros who are using it in El Salvador. That's it. It's just not being used.
Sure. Okay, fine. So it really does have to be like on some sort of scale. It can't just be like randomly.
I think we set the thing at either 5% or 10% of like retail activity. Yeah.
Oh, yeah. Yeah, I have to say, I remember being with you back in 2014 when I was sort of less in all this stuff, but still, I remember siding with you on the argument that this is a speculative thing. So why would I spend something that is speculative? So in any case, all right, let's move along here to what this was intended to be, but let's talk about what's happened over the last week. And I want to give you a quick scenario of like, here's my read, and then you tell me yes, correct, and we can take it from there. So it felt like, I don't know even what day it was, Tuesday, Wednesday of last week, you have the Silvergate stuff happening where basically you hear Silvergate Bank is being liquidated. Maybe it was even earlier than that. And that, felt like news, but it was very quickly trumped by the news that there had been this run on Silicon Valley Bank, and there was this panic around what was happening at Silicon Valley Bank. And these things feel like they are linked for many reasons, obviously, but in the sense that it feels like both these banks were in this situation where they had these long-term assets on their books, specifically like T-bills and maybe some mortgage-backed securities, that had lost a lot of value, kind of on paper value, because interest rates had gone up. And then they were both very dependent on a particular industry. In Silvergate's case, of course, crypto. In Silicon Valley Bank's case, of course, like tech and startups. And both those industries were doing very poorly. So you had this perfect storm of depositors pulling money and their books being super devalued. And that led to basically the crash of both of these. Is that the right summary? And are those the two fault lines you would name here, which were the rise of interest rates devaluing their books and being so dependent on sort of a singular industry that has been having a lot of problems lately?
Yes, those are the 2 big ones. And then I would add to that the fact that in both cases, the industries, for very weird and idiosyncratic reasons, were happy to be sitting on millions of dollars in their deposit accounts at the bank. Most businesses, if they have, $10 million, are going to be, putting it at least in treasury bills where you can earn 5%, right? They're not just going to keep it on deposit at the bank earning like 0. But for weird crypto-related and tech-related reasons, both Silvergate and SVB had massive deposit bases of like big uninsured deposits. They were basically borrowing money from crypto companies and from tech companies at 0%, and millions of dollars which were uninsured. And that doesn't make a lot of sense, and that doesn't happen very often in the world, but it happened in this case. And so that helped contribute to the run.
I can understand why that would happen in crypto, because of course it's harder to get a bank if you're a crypto company, and so you are sort of dependent on whoever will take you, let's say, right? In this case it was Silvergate, and we can talk about Signature in a little bit, which is the other big one. But why is that true? Like, why are these tech startups keeping all their money with basically no interest rates at SVB?
It's a very, well, basically because they're too small and too young to have a CFO or a treasurer, and so they're like, we'll just keep it at the bank. We're too busy, like, making software to worry about, like, what are we going to do with our money? And as long as our money's in the bank and we can use it to make payroll, that's fine.
That makes sense. Okay, so then let me ask you this. What are the differences? Like, what I want to ask is, where are we now, right? Like with Silvergate, people are probably familiar, or with SVB, people are probably familiar that, the federal government has said they're going to step in and protect depositors. But where are we with Silvergate and with SVB?
So that we have had two actual bank failures, which were SVB and Signature.
Okay.
And we have had...
When did the Signature failure happen? I can't
Sunday
keep it all
night.
straight now. Okay, so that was Sunday night.
Signature was taken over on Sunday night. The Silvergate failure is technically not a failure. Technically, it's a voluntary liquidation. Basically, they're saying, we're losing money. We can't operate as a going concern anymore, so we're going to liquidate our assets. We're going to pay out our depositors, and whatever's left over, we'll, use the subway fare.
Okay, what is the difference between those two? Because liquidating as a bank kind of sounds like a failure to me.
Yeah, I mean, it has collapsed. It has ended. People are not going to be able to bank with it anymore. Like, don't think of it as a active bank. Think of it as a former bank. It has not been taken over by the FDIC because right now it is managing to pay out all of its liabilities, i.e. its deposits.
So that's one of the big differences here. This is what I'm trying to get at, is like, what is the difference? And again, I'm almost putting Signature aside because there's too many banks that start with S that we're talking about here. It's SI, it's like, that's the warning sign, is don't name your bank something that begins with SI. But so you've got the difference between Silvergate and Silicon Valley Bank is Silicon Valley actually had this run that left it unable to actually pay out what it needed to for its depositors. And that's why the FDIC had to step in and has now said, okay, we're going to protect these depositors. Whereas Silvergate is able to meet all its obligations, pay out what it needs to pay out, and kind of close in an orderly way. Is that the distinction?
Yeah,
okay. That makes sense to me now. Okay, so then looking at Silicon Valley Bank and the fact that you have the FDIC has now stepped in, they're saying depositors are going to be protected. My sense is they're still looking for a buyer for that, in the sense that the government doesn't want to have to actually be on the hook to pay out depositors. They're hoping that a bigger bank with more reserves steps in and basically takes that on. Is that right?
I think there are different arms of the government, and different arms of the government want different things. The FDIC would love to find a buyer for Silicon Valley Bank. Silicon Valley Bank was either the 16th or the 20th biggest bank in the US, depending on how you measure. So there aren't that many banks that are big enough to buy it. The banks that are big enough to buy it tend to be big banks, and the FTC tends to not want that kind of concentration in the banking industry. So one of the problems over the weekend, like, we're still getting this reported out, it's not clear exactly what happened, is was there objections from other bits of the government to Silicon Valley Bank getting, eaten up by some monster bank, and then there's this other thing, which is, well, could a non-bank buy it? Could private equity buy it or something like that? And that's where the Fed steps in and says, no, we don't want non-banks to own banks. As a matter of macroprudential policy, that's just something we don't want. And so if a non-bank can't buy it, and a small bank can't buy it because it's not big enough, and a big bank can't buy it because then it will get too big, then that creates a problem of who is even allowed to buy this thing.
So it's an interesting argument. You're saying it's the FTC that doesn't want a bigger bank to buy it because they're worried about sort of not monopolies, because there's a lot of banks here, but something on the order of monopolies, right? We don't want to make these banks more powerful. Isn't the argument if you don't find a buyer for this thing, that people will flock to the bigger banks anyways. They will end up de facto giving bigger banks more power because they'll be too worried about how these regional banks are going to be able to continue to operate? Or is that not really a concern at this point since the government is backstopping depositors?
Yeah, so that was definitely a concern on Monday. Was it a concern on Tuesday? I don't know. This is moving.
It's been 3 hours, Carly. Everything has changed.
So yeah, in most countries there are only 3 or 4 banks. Right. The natural tendency of any banking system is to consolidate for partly this reason. And the US has done a lot of work on various different fronts to try and prevent the entire country from being taken over by 3 or 4 banks. And it is by far, there are orders of magnitude more banks in America than there are in any other country. It's thousands and thousands of banks. And anyone who comes here from another country is like, why do you have so many banks? This makes no sense. Bank regulators, for various reasons, want this, and they worry when there are big bank mergers because, they worry that the small banks aren't going to be able to compete. Is this the right time to worry about such things? Probably not. My guess is that Silicon Valley Bank will get taken over, partly because it really did play an largely irreplaceable role in the economy of Silicon Valley. That if you're a startup with 2 employees and you've just raised a $5 million seed round and you need a bank account, Silicon Valley Bank will be there for you and be able to support you in a way that most banks will be like, who the fuck are you and what's going on?
Y'all know I love Ledger, the world leader in critical digital asset security. When you own crypto, what you actually own is a private key that gives you access to your coins. It is imperative that you keep this key safe, and Ledger wallets are the best way to do that. The Nano S Plus and Nano X Ledger wallets, paired with the Ledger Live app, give you the best way to start your crypto journey while maintaining full control over your digital assets. Send and sign your NFT transactions with full transparency in the Ledger Live app. What you see is what you sign. And y'all have heard me talk about Ledger Stacks before. Well, due to unprecedented demand, Ledger has received all the Ledger Stacks pre-orders that it can fulfill through summer 2023. And so they have decided to pause the pre-orders. Ledger is incredibly grateful for the community's support and is working hard to get current pre-orders out and ready to ship so that they can make even more Ledger Stacks to keep your digital assets secure. Sign up for the Ledger Stacks waitlist and be the first to know when Ledger Stacks are available again for pre-orders. But don't leave your digital assets susceptible to breach or hack in the meantime. Order your Nano S Plus or Nano X today by visiting shop.ledger.com or clicking the link in the show notes.
What is the difference, and this is a theme that I want to get on from a couple of different angles. Why has it been harder, or has it been, to find a buyer for Silicon Valley Bank than it was in 2008? You just laid out the reasons why it's been a little bit, there's these competing interests. Did those competing interests not exist in 2008? Is this all because we've learned something from 2008? Why is this playing out what feels like differently?
So 2008 was incredibly weird and unique in a bunch of different ways. The fact is that for all that Tim Geithner at the New York Fed was trying to orchestrate all manner of mergers, there weren't a huge number of them. So JP Morgan took over Bear Stearns and Washington Mutual and a few other smaller banks. I guess there was...
Citi? Wasn't Citi involved in something?
Citi took over nothing. Bank of America took over Merrill Lynch.
Oh, that's what it was. Okay.
And that's about it, really. And those were very chaotic times, and those were not easy takeovers. One of the problems with Silicon Valley Bank, I was on a call with a Treasury official on Sunday night, and that person said that, it wasn't so much that Silicon Valley Bank couldn't just be taken over. It was more that they just didn't have the time to do it before Monday morning. So the sale process is still going on, and there is still this feeling that Silicon Valley Bank could yet be sold, in which would definitely be the best case outcome for its customers. There is a very strong feeling that Signature Bank is going to get sold. No one seems to doubt that Signature Bank is going to wind up getting sold.
And Signature is easier because it's smaller?
Yes. And also because it didn't suffer, like it didn't have the same kind of concentrated deposit base, right? Like Silicon Valley Bank worked as a bank because it had this massive deposit base. All those deposits have basically left at this point. There was this massive run on the bank. And so if you're going to buy Silicon Valley Bank, what exactly are you buying? You're buying like some valuable relationships, but no actual money in them. And like, can you get that money back? And if you can't get that money back, how are you going to make money? There's a lot of questions there about like, where is the financial value in SVB? Whereas Signature Bank is this bank that has been around for decades in New York City and has banked a bunch of like really normal, boring businesses in New York City that had nothing to do with crypto. And there's value in that.
If Signature Bank is acquired, so a lot of or some number of crypto firms that were banking with Silvergate, including Coinbase, for example, switched to Signature Bank. And then, of course, now Signature Bank is having issues. If it gets acquired, do you think that complicates anything for crypto companies that are banking with them? Like, will an
100%.
acquirer? Okay.
Yeah, like Barney Frank, who was on the board of Signature Bank, is on the record saying, like, we could have just taken advantage of the Fed discount window thing that was announced on Sunday night just as much as anyone else. And like, why did they intervene to fail Signature Bank when they didn't intervene with anyone else? And the answer, according to Barney Frank, is because something crypto. They wanted to make a point about like, we don't like crypto banks. And he's a board member of Signature Bank, and take what he said with as many grains of salt as you want. But it does seem to be the case that there's been extraordinarily explicit messaging from every single conceivable bank regulator, the SEC, the OCC, the FDIC, the Federal Reserve, basically saying, please don't touch crypto. Crypto is way too fucking risky. Get out of crypto. There were only two banks who really touched crypto, and they have both now failed. If and when Signature Bank, and even before Sunday, Signature Bank was very explicitly and loudly getting out of crypto. They were not banking new crypto firms. They were saying, we're trying to run down our deposits. We're trying to like tell these people to go somewhere else. If and when Signature Bank is bought, I can pretty much guarantee you that the buyer is going to be like, we bought this for all of the non-crypto related businesses, and we are going to tell whatever crypto customers we still have that they are not welcome anymore. So yeah, the crypto industry has a real problem that it doesn't have any ability to open a bank account in America anymore.
Which I think, obviously, crypto advocates would say is a huge problem. That's how you end up with FTX, right? You just end up pushing these things offshore instead of creating guidance and ways for crypto companies like a Coinbase, who clearly wants to play ball with the U.S., instead of giving them guidelines that they can follow and play ball in the U.S., you go offshore, and then all bets are off, and that's how you end up actually hurting U.S. retail consumers more. What do you think of that?
Well, I totally agreed with you until the hurting U.S. consumers more bit.
Okay.
Because the whole point about like FTX being based in the Bahamas was that it didn't actually have that many U.S. retail consumers, right? There was this thing called FTX US, which didn't have a massive customer base, but people who had money at FTX US obviously lost money. There was, I can't remember who, there was a good like op-ed in the FT a couple months ago called like Burn It All Down or something, which basically said like the best thing that regulators can do in terms of crypto is to just say no, right? To make it
box us out.
To make it absolutely obvious that if you are going into crypto, you are having to do weird things with like VPNs and things in the Bahamas and things that are obviously highly risky. And so long as people are taking risks that are obviously highly risky, that's fine, right? If people are buying Bitcoin, it's, or Solana or any other fucking shitcoin or, overpriced monkey JPEGs, like it's an obvious risk, and they know they're walking in with their eyes open, and if they lose that money, it's money they could afford to lose. The problem with crypto was that you had people like Gemini, offering fucking 8% yields on USDC or Tether or whatever, right? Well, not Tether, USDC. And basically saying, like, these are dollars, and you can get, like, impressive rates of return on your dollars. And there's no risk here. And people were putting in money they couldn't afford to lose on the basis that it was a risk-free thing and it was based in America, and like Coinbase was regulated by the SEC and all of this kind of reassuring stuff. And so if you get rid of the reassuring stuff, like this is American, this is based in dollars, then at that point, the risk goes away. Like the only people taking risks are people who are willing to VPN into the Bahamas.
Sophisticated enough to know how to VPN into the Bahamas.
And then you're like, fine, if those people want to lose money, all power to them.
Right. And again, this is not what this episode is meant to be, but I think to me and to, you know, obviously people who are enthusiastic about blockchain's future feel like set rules that require more disclaimers, more disclosures, that limit your ability to say like going to the moon, that create, to my mind, the same effect of like not encouraging people to just splurge money they don't have, thinking that this is like risk-free, while still allowing the US to participate in a blockchain future and a blockchain economy. Again, not the debates we're having here. I understand you disagree and you just find much less utility in blockchain broadly. But that, you know, that would be obviously squarely the camp I land in. Okay, let's talk about Silvergate. Silvergate isn't going to be acquired, and is that because it's crypto? It's all crypto. Like, I'm trying to get this picture here. So, like, Silicon Valley Bank might be acquired. It's hard because it's big. Signature Bank will be acquired because it has a lot of different customers, but they're going to box out the crypto customers. Yeah. Silvergate's basically all crypto. It's screwed.
Yeah, exactly.
Okay. Great.
Like the OCC and the Fed they won't allow anyone to buy Silvergate because there's nothing there that they want. They don't want to see any of that activity happening. And the fact that it's closing down makes them very happy.
Sad. So jumping then back to Silicon Valley Bank, you said you think they'll find a buyer. I want to talk about these two scenarios. If they weren't, for example, to find a buyer, what does that mean? We know depositors are protected because the government has said the depositors are protected. Is that because the government pulls from its coffers to pay back these depositors in a scenario where there isn't a buyer?
Yeah. So there's this thing called the FDIC Deposit Insurance Fund, the DIF, which has $125 billion in it. Okay. And that's Feels more good. Than enough money to be able to pay out all of SVB's depositors. And then, of course, in return, it gets all of SVB's assets, which are worth roughly $125 billion. So at the end of the day, it's not going to wind up losing a huge amount of money.
So this then gets to actually a very core question that I've been curious about for a long time in some ways, even I think even predating this whole crisis. So, you know, this term, it's almost this term bailout. I think you had a piece recently that was like, let the debates about bailouts begin or something. But like when you look back at 2008, obviously there was a lot of frustration that it felt like we bailed out these big banks and, you know, we bailed out kind of the rich people, call it. And that it like came at the expense of the taxpayer since it was the government doing this bailing out. But if you look in the long term, and it didn't even take that long, like the government made a lot of money on 2008.
But the banks survived, right? That was the thing. So like the government bails out Goldman Sachs and converts it to a bank and makes sure that it has access to the Fed liquidity, and then, you know, Goldman Sachs survives and the CEO continues to make $30 million a year, and then, you know, whatever government money was used for that bailout, yeah, it gets paid back with interest and makes a profit. So it didn't cost taxpayers. But the fact is that absent that government bailout, you know, Goldman Sachs would not be with us anymore, and its CEO would not be making $30 million a year. That is not what happened with Silicon Valley Bank. Silicon Valley Bank is dead. Its shareholders all went to zero. Its executives all got fired. And so, like, we didn't buy... Janet Yellen, the Treasury Secretary, was at pains to make this point. We did not bail out the bank. We did not bail out the executives. We did not bail out the shareholders. We didn't even bail out the bondholders. The only people we bailed out were the depositors.
I saw something that said the CEO of Silicon Valley Bank like cashed out $4 million of his stock like the day before everything went down. Is this true, or is this Twitter rumor? Do you know?
No, this is true. He was on a 10B5 plan or whatever they're called, and so he'd been selling stock for a while. And so, yeah, there's a good chance that might wind up getting clawed back.
Oh, interesting. So I think that's an important distinction. Is the not bailing out, call it the shareholders and the executives of Silicon Valley Bank, is that because we learned something from 2008 or because it's not a systemically important bank? Like if we were to run back 2008, I imagine we would save Goldman Sachs again, and we would still bail it out.
Right, exactly. And that's why all of the deposits are going to what's known as SIBs, the systemically important banks, right? So there are still banks in America. They're called GSIBs. GSIB is basically another way of spelling too big to fail. And if a bank is too big to fail, then it won't fail. If you have cash on deposit at JP Morgan or Citigroup or even Goldman Sachs, you know that bank is too big to fail, and therefore you can feel safe in having your money there. If you have cash on deposit at Silicon Valley Bank, it is not too big to fail. In fact, it does fail, and in the end you get your money back, but only because of extraordinary actions by the government. So yeah, in that sense, too big to fail banks, they do still exist. They would get bailed out, or they would get, there would be something along those lines if they got into trouble, but they're not getting into trouble, so that's fine.
Who are the leading candidates right now? Because again, there's only a handful on like who is likely to buy Silicon Valley Bank. So you are somebody who believes that it probably will be bought.
Well, I mean, I don't know. It's very interesting. I don't know whether it will be bought or who will buy it. Like, I keep on hearing Barclays for some reason. Like, it's possible that it'll be a foreign institution like Barclays or UBS. It could be another regional bank like Truist, which is big enough to be able to absorb it. There aren't that many of them, but there are a couple. Or like, the FTC could get over its, get off its moral high horse and allow it to get sold to like, Goldman Sachs or JP Morgan or someone like that. There's a few different possibilities.
Do you personally have a feeling on what would be best? Like
best for whom?
For, I don't know, the U.S. taxpayer? I don't know, your average human?
I think average humans don't really have a dog in this fight.
Sure.
I think for me, I would say something like Truist, which doesn't make like the too big to fail banks even bigger, but like expands the footprint and keeps like those kind of relationships alive. That would seem like a good solution to me.
How much blame do you or should we lay at the feet of SVB themselves? Because I think something that's so interesting in this case is like in 2008, it felt pretty clear cut. Like the greed had gotten out of hand, and like, these subprime mortgages were clearly risky and worth nothing, and this whole thing had been allowed to like proliferate. That's not really the case here, right? Like they were investing in T-bills, and the quick interest rate hikes were problematic, and they were, they were invested in relatively safe assets. So how much do you fault them for what happened?
So this is a really, really boring, nerdy terminological thing. They weren't invested in T-bills, they were invested in T-bonds. Oh. T-bills do not have interest rate risk. T-bonds do have interest rate risk.
Okay. I didn't know that, and I'm glad to know that.
And actually, what they were invested in was not T-bonds, they were invested in agency MBS. And I'm not going to get into what agency MBS is, but basically... It's
mortgage-backed securities of some sort. But then people freak out because they think 2008, and you're like, well, it's different than the subprime stuff.
You are right that the thing they were buying did not have any credit risk. Silicon Valley Bank did not fail because it made bad loans. It didn't make bad loans to customers, and it didn't make bad loans to the government, and the people it loaned money to were always going to pay it back. The people it loaned money to were overwhelmingly Fannie Mae and Freddie Mac, which are owned by the government and are 100% likely to pay back when they have to, right? And so...
79% owned by the government.
Well, enough owned by the government.
I know. I'm just joking because I'm thinking of anyways. That's a different rabbit hole. Continue.
Yeah. So yeah, if you have like equity and if you have preferred stock in those guys, good luck to you.
If you're Bill Ackman, you're very upset by the whole situation.
Anything that upsets Bill Ackman is signed by me. No, but in general, there are two types of risk that bond investors take, and Silicon Valley Bank was a bond investor who was buying risk. Was buying bonds, right? There's interest rate risk and there's credit risk. It very deliberately took no credit risk. It wasn't running the risk that the people it was lending money to are going to default. It did take interest rate risk. It took quite a lot of interest rate risk, and it took a kind of stupid amount of interest rate risk. So, when it bought bonds for $100 billion, like after a few months, suddenly those bonds were worth $83 billion. And they're like, shit, we've just lost $17 billion. And it's like, technically, they hadn't lost that money because they hadn't sold the bonds, right?
Sure.
And they were
It's all
holding
on
the bonds
paper.
to maturity, and so long as the deposit base remained where it was, they could hold everything to maturity, and deposits are normally stable, and that's all fine, right? Of course, the problem was that they didn't have a stable deposit base. So when the deposits started flowing out, they needed to sell the bonds. When they needed to sell the bonds, they needed to mark them to market. When they marked them to market, they took massive losses. And that was like the death spiral of Silicon Valley Bank. It would have been a good idea, with hindsight, for them to actually have a chief risk officer for those like 8 months when they were buying those bonds.
Okay. So that's one thing. So that was going to be my next question. Like, what should they have done? And it sounds like certainly maybe just held more cash, held more short-term treasury bonds.
They could buy long-term bonds, but just make sure they were floating rate instead of fixed rate. That would have done the trick.
Oh, because then they would have moved with the interest rates as they were raised.
Exactly.
And the reason you buy fixed rates is at the time you're getting a better return from a fixed rate. Is that how that
Exactly.
works?
Yes.
You're getting a better rate at the time they bought them,
Yeah.
not anticipating that interest rates were going to like triple in the
Exactly.
over the following 8 months. Okay.
Yeah.
Do you lay, there's a I would say maybe cohort of Silicon Valley, probably slightly right-leaning capitalists who feel like mad at regulators and feel like, oh, you guys downplayed inflation when it suited your desire to spend money. And then you finally woke up to inflation and you rose rates tremendously. And now you want to blame these banks who got caught in those crosshairs.
I mean, get over yourselves. Jesus Christ. It is not the job of the Fed to worry about Silicon Valley venture capitalists.
Well, what about regulators? This was a bank that was in regulatory compliance.
Right. And the San Francisco Fed is looking like it was asleep at the wheel on this one. Like, the San Francisco Fed was the main regulator of Silicon Valley Bank, and it does seem like they should have been much more on top of this rate risk than they were.
So it seems like this is a combination of some like local regulatory, the San Francisco Fed should have been more on top of this. And then Silicon Valley Bank, clearly, at the end of the day, you can't not lay the bulk of the blame at the feet of the institution that did this. What is the feeling, what is your impression of the feeling of most of Silicon Valley? Like I had somebody on the podcast who is the president of a company that was banking with Silicon Valley Bank. And he seemed like pretty forgiving of SVB. Again, like FTX collapses and everyone's like, fuck FTX. And like, it's very clearly FTX's fault. Mm-hmm. But it seems like people who banked with SVB kind of loved SVB and are sort of sympathetic. Is that the vibe you're getting as well?
So, yes, Silicon Valley Bank was genuinely beloved in Silicon Valley. It had deep roots in Silicon Valley, and there was a reason why it was the go-to bank for every startup and every venture capital company. Like, it just had those relationships. And I think that a lot of the people at, like the chap you were talking to, understand that their counterparties, their relationship managers at Silicon Valley Bank did nothing wrong, right? Their relationship managers were still very good at providing excellent transaction banking services to their customers. And they would very much like to be able to continue to bank with a bank that has those kind of relationship managers.
Stepping back and just looking ahead, like, are there more shoes to fall here? Or is this something that basically started and has now been more or less resolved with, the details to be hashed out within a week?
Right now, as we record this on Tuesday morning, I'm going to say the crisis is basically behind us at this point.
Okay.
But never say never. As my the subtitle of my book is it talks about this thing called the new not normal, which basically expect the unexpected. This crisis did kind of come out of left field, and it is entirely possible that another crisis is going to come out of left field pretty soon as well. Like these things, what does Macbeth say about woes coming in battalions? It's entirely possible there'll be something else, but it won't be the obvious thing. There'll be some other weird blow up, and everyone will be like, "What the fuck?" They are all dominoes in one respect. we had 3 Arrows Capital blow up and Terra blow up, and then somehow that all like kind of fell through to FTX blowing up, and then that caused Genesis to blow up, and then maybe Gemini's blowing up, and Silvergate's blowing up, and then somehow it's surely not a coincidence that SVB fails like the day after Silvergate fails, right? So there's some kind of a connection there, and then Signature fails. Like these are all dominoes. They're not obviously connected, right? But they're all dominoes. They're all connected to each other in some sense, and it would be foolish to assume that they're the last domino. Certainly, I think other big crypto companies, and there aren't very many left at this point, but I was, Gemini and Coinbase, you have to worry about what's going to happen to them.
What is your just broader financial outlook? I think there's debates about like, are things about to get a lot worse, and is this year going to be a deeper recession, or is
deeper
maybe the bottom?
What? We haven't had a recession since like 2 months in 2020.
Okay, fine. That's also the thing that's confusing about this economic time, right? Is like we're not in a recession, and maybe we haven't been in a recession yet, but it has
It's one of my favorite charts. If you ask Americans like, are we in a recession? Then basically for the past year, more than 50% of Americans are like, yeah, we're in a recession right now, and it's like clearly we weren't, but like everyone thinks we are.
And we didn't even hit because the definition, right, is 2 quarters of negative GDP growth. Is that the kind of historical definition?
That's a rule of thumb rather than a definition.
Okay.
We did actually technically have that, but like that wasn't a recession when we had
but so that's confusing then, because it feels like can't we just have like some specific definition, and then if we hit it technically it means that. But anyway, so or do you think we're going to enter a recession, we'll say, right, this year, and things will get gloomier than they are now, regardless of how we're going to call it? Or do you feel like the bottom is in, or we're circling the bottom? I mean, stocks and everything's pumping today, right? But like at some point in the last 6 months or the next 2 months, we'll kind of hit some sort of bottom, and it'll be upwards and onwards from there.
The U.S. economy and the U.S. consumer have proved unbelievably resilient over the past year, 18 months. And at some point there will be a recession, right? It is the only certainty is that there will be a recession. No one knows when it's going to be. If you look at all of the sort of investment bank sell-side research predictions of like when the recession is going to come, they keep on getting pushed off by 6 months. Every 6 months, like, it's coming, but it never comes, right? So it could be 5 years until there's the next recession. Like no one really knows. The Fed seems to be coming to the end of its tightening cycle. We're only going to get like 25 basis points probably on the 21st. We've got slightly tighter financial conditions now just as a result of this mini banking crisis, but that's not going to cause a recession. It's hard to see what the cause of recession is going to be. Like rents are coming down. Inflation is coming down. Where's the shock that's going to cause it?
Is part of the confusion here because we kind of have 2 economies in this country at this point? Like you have the tech, finance, crypto, high growth sector, heavily invested in markets, folks who have been hit pretty hard in the sense that, you've had crypto prices fall pretty dramatically, high growth stock prices have fallen. Meta is doing another round of massive layoffs, it sounds like, over the next 2 months, in addition to all the layoffs that have come. And those are very like grabby industries that get a lot of flashy headlines. And so that's where it can feel very like kind of recession. And yet you have this whole other half of the economy where jobs are actually growing and people are hiring. And is that in some ways why this is confusing?
Yeah, exactly. But there's a lot, like people love to look at stonks and think they reflect the economy, right? People love to look at, headlines about how many people are being fired by Facebook and think that reflects the economy. It doesn't. It reflects which side of the bed Mark Zuckerberg woke up on this morning.
Sure. I mean, journalists also we like reading about it, but it's also what we get fed. Journalists like writing about it, so.
And yeah, but if you just look at the jobs reports that have been coming out on the first Friday of every month, it's massive numbers. The last one just came out at the beginning of March, and it showed 311,000 new jobs created in the economy. That's net of all of the layoffs that happened in Silicon Valley. They're just pumping out new jobs.
And an interesting and seemingly positive, I haven't really dug into it, but inflation report that came out this morning for February that showed inflation coming down a bit, and so probably means that the Fed won't become more aggressive in its rate hikes, at least for now.
Yep, exactly.
Well, thank you for joining me, Felix. My true last question, I know I just, well, actually, do I need to ask it? I guess I don't need to ask this. It's kind of implied. Like, crypto's obviously pumping right now. And, I'm curious your thoughts on that, because obviously it fell pretty precipitously after Silvergate. And I'm assuming it's just pumping because it's correlated with all these other assets. And
it's a risk. Yeah, it's a risk asset. Like there genuinely was a time, like 10 years ago, when crypto was an uncorrelated asset and you could diversify, you could meaningfully diversify by buying crypto. At this point, those days are long gone. Now it's just a risk asset along with everything else.
Agreed. But we'll see. I mean, again, we should have you back. I don't know if the audience is going to be mad that I didn't go into the Ethereum conversation, but it's such a longer, it wasn't what we planned for, and it's such a longer.
I am happy to. I mean, I should be getting 1 ETH from Ben Horowitz in 2014, and I will come back on your show, and you will tell me what I'm meant to do with my ETH once I get it.
Yeah. Well,
should I invest it in monkey JPEGs?
I would just say hold it, right? Like if you're not going to be active in the ecosystem, I think hold on to your Ether.
Okay. Well, I will hold on to my ETH. I will hold it at Coinbase, and then Coinbase will go bust, and then I will no longer have the ETH.
Well, we'll definitely have you back on if that happens. All right.
Okay. Thanks, Gally.
Felix, thank you so much. I really appreciate it.
This was fun.
Thank you so much for watching this episode of Overpriced JPEGs. If you liked this conversation, if you liked this episode, please go ahead and hit subscribe. It helps me out, it helps the show out, and it means you will get alerts and updates when we post new content. Thanks again.